From Washington, this is the Macrocast, a podcast brought to you by Penta and Markets Policy Partners.
Good morning. It's Friday, December 9th. You're listening to the Macrocast. I'm Matt McDonald, president of Penta, joined as always by John Fagan and Brendan Walsh from Markets Policy Partners. And this week, we're also joined by John Dick, CEO of CivicScience, to talk a little bit of the retail shopping highlights holiday season. John, what's going on? What are you seeing in the, we had our ESI release, kind of checking on consumer sentiment, but what's going on out there in the real economy?
Yeah, I mean, where to start, right? Well, first of all, our economic sentiment index, this number this week, frankly surprised. I mean, the steepness of the acceleration of positive sentiment from consumers, I think surprised all of us a little. It was the steepest 2-week climb we've seen since July. We're well above. In fact, the ESI is right now at the highest we've seen it overall since about April, which is generally a really positive sign about how consumers are feeling today. The one sort of outlier so personal finances, people were more optimistic. Major purchases, certainly the job market, of course, is still sort of a highlight. The one negative number was consumers' sort of longer term outlook for the economy, optimism for the U.S. economy 6 months and out. It's hard to know how much of that's real and how much of it's just because they read the headlines that we all read, right? And they're sort of being told to believe things are going to be bad, which sort of misaligns kind of reality with expectations. But you know, where the rubber hits the road in spending, people are just continue to be remarkably resilient. I mean, Black Friday numbers definitely surprised on the upside. A lot of that was driven by Gen Z, believe it or not. Actually, get it. My daughter was like sort of a statistic on this. Like she and 10 of her friends got up at 5 o'clock in the morning on Friday after Thanksgiving and went store hopping. Like it was so retro. It was, and there were a lot of signs that was going to happen because I think younger people in particular are like still sort of starving for that kind of social experience. But, you know, at the end of the day, the numbers were strong, you know, and people are, and I think what's even, what I think makes those numbers even better and more surprising is, you know, we tend to look at Black Friday and sort of, and Cyber Monday, which also did pretty well. We look at the sort of year over year comps of those things, which were up, but what was unusual, and I know we throw the word unprecedented around a lot, is that doesn't take into account how much earlier people shopped this year. You know, we're seeing that every year now. People started holiday shopping in June and July when Amazon had its first sort of Prime Days events. And so we're not only spreading out holiday retail spending over a longer period, but we still had, even with that, we had a really surprising returns on Black Friday. So look, not that there aren't signs of headwinds. Of course, when we talk more about the economy and sort of your guys' areas of expertise, there's obviously lots of reasons to be pessimistic, but it's just not landing with the consumers just yet, at least not in the form of spending. Yeah,
it's interesting. I mean, obviously, job market's holding up as well, pretty robustly. And even though you see kind of anecdotal headlines around CEO sentiment, companies cutting jobs, that's not what the aggregate says. It's, you know, on the job side, it's kind of there's this good news, bad news story of like obviously we don't want a recession, but the Fed also wants things to cool off. John or Brendan, when you think about the retail side of stuff, what is the Fed looking at in like the kind of holiday shopping season numbers? Like, do they want a dial down on that or no? I mean, it's not exactly the same as kind of like wage inflation and that sort of thing.
Yeah, I mean, I would assume that they've said that they want to, essentially, Fed speakers have said they want to cool demand, and so they're John, they don't want your daughter and her friends going to the mall. They want them to stay home in a darkened room and listen to depressing music, drink tap water, and it's
Merry Christmas, everybody.
Well, I wasn't thrilled about the debit card bill myself, to be honest with you.
No, it's pretty explicit. The Fed is very much, in Fed speak, as plainly as they can say it. They want shoppers to, on the margin, spend less, stay home, and dial back demand. That's the path they see to suppressing inflation, which we got a higher than expected producer price index reading this morning. So it's not a smooth ride to low inflation by any stretch of the imagination. The Fed keeps saying they're going to do more. Yeah. And we've got retail sales coming out next week. We've got a gauntlet on the macro side next week, and that's one of the data points. And markets have been very reactive to these because of the assumption that higher numbers, even small upside surprises, give the Fed the excuse to keep tightening the screws.
Look, I will add, though, I mean, just to balance my take on it, we are definitely seeing an uptick in credit card usage. The percentage of consumers who say they expect to take on some form of debt to cover holiday gift costs this year is up to 11%, which isn't a huge number, but it's up from 9% in 2019. I mean, throw 20 and 21 out of the mix. But so we are seeing an uptick in that. We're seeing an acceleration in the use of buy now, pay later, tools. So there's certainly, but again, also that's also being driven primarily by younger consumers. Whereas say in 2019, more of that debt was like parents and up. This one tends to be younger people. So there's again certainly signs that things aren't as great as they were a year ago, but it's not as dramatic as I think a lot of people would have expected.
Brendan, did you want to touch on the bank conference this week?
Yeah, so Goldman Sachs held there. It's the last one of the year, and all the big names go down to the tip of Manhattan and discuss. And it was somewhat mixed message, but I would say overall the message was kind of bank CEOs are concerned about 2023. Things are the consumer's holding up pretty fine, but I think there's a concern that the Fed is over tightening, and that there's a chance that the best case scenario is, growth slows, inflation slows, and we have muted growth. But I think that the odds of us having an actual recession, if not a deep one, are going up, and bank CEOs are expressing that concern.
Do you think that's reflected in the market perception?
It certainly is in the bond market. Basically, every measure of our yield curves are inverted, and they have been for a while, and they're getting even more so. And we saw this week in a risk-off scenario, bond yields keep going lower. Bonds are rallying. People are buying more bonds, which drives the price up, which drives the yields down. Ironically, I think if the Fed really wants to raise rates, the best thing they could do would be to pause their rates hikes. The market is telling them that they're over tightening and misreading the inflation scenario. Actually, the CPI linked bonds for 1 year out now are trading at 1.99%. So the market is telling the Fed that in a year we think that inflation is going to be below 2%. The equity market is just kind of in no man's land a little bit. Some days it goes up, some days it goes down, and I think it's waiting for more clarity on the macro picture before we have consensus on what 2023 earnings are going to look like, because though that delta can be massive. If we go into recession, it's going to consensus earnings way too high. If we miss it, consensus earnings might be too low.
Yeah, the timing exercise on all of this stuff is pretty fascinating because, John, you were talking about consumer sentiment over like the 6 month plus time horizon. And even with the forecast, I feel like we've been in this perpetual loop where the economists have been saying, oh, we're forecasting a recession in a year, and it always is a year away. It's always a year away, no matter how closer you get to that date.
I think if you ask the layperson consumer, look, when we ask sort of the average person their outlook for the long-term economy, these aren't economists we're talking to, right? This is just, the average person. And you keep hearing this sort of, it's going to come. There's sort of like signs of this mindset with the consumer of like, okay, let's just get it over with then, right? Like if it's going to happen, like, let's just do it. Let's ride it out. Let's get on the other side of it because we're sick of hearing about it. And it's making us question what things that we're otherwise generally pretty happy about. It's interesting psychology for the consumer.
Yeah, so the psychology of anticipating bad events is usually way worse than the actual event itself. You don't want to sit around contemplating a bad thing. You just want to take your medicine and be done.
You guys,
all right, let's take a short break. When we come back, we'll continue the conversation, touch a little bit on 2023 and the and where oil prices are as well. You're listening to the Macrocast.
On the first Friday of every month, Penta analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at pentagroup.co or on Twitter at PentaGRP.
All right, we're back with the Macrocast. We're talking a little bit about expectations for 2023. John, I cut you off before the break. What were you going to chime in with there?
Yeah, I wanted to follow up on the point you made about sort of the psychology of expectations. And this is just me as a listener to your podcast pretty much asking this question is like, how much of that the prognosticators and or sort of the Jamie Dimons of the world, the sort of like the thought leaders in this space, how much are they incentivized to over-ring the alarm bells such that, they're kind of under-promising, over-delivering on outcomes so that we sort of set expectations more negatively and at least the perception of a soft landing is more real?
I mean, John and Brendan jump in here, but like my take on this stuff is that it's like the Fed in particular and the markets, but then leaders, companies, all of this, it's like, I mean, this is a part of the problem with inflation and stuff is that you're in this like double kabuki theater where like, one group is like pretending to be one thing and then the other group is trying to figure out whether they really mean it or do they not mean it. And then it's this interaction because you're kind of like, to take the Fed and the markets as one example is that, everybody wants the same goal. Everybody wants to land the plane cleanly at the same time. And it's this dual, the Fed can't do it without paying attention to what the markets think. And the markets are going to respond to what the Fed is doing, but also what they think the Fed is really going to do because they know it's like it's like that scene in Princess Bride where they're talking about the poison. And it's like, the markets are saying to the Fed, but I know that I know that you're not really going to do whatever. Right. And you kind of just spiral down this cave of interactions that it's hard to parse this stuff out, right? It's not, I mean, the other example that's obviously highly relevant in recent memory for us is the communications around COVID and the pandemic is like, I would say that the health apparatus had communications that were trying to get to that weren't necessarily direct or on point in terms of what the reality was that were trying to elicit behaviors. But then you start this cycle of like, okay, but you're saying that because you want me to do X. And I know that you're saying that because you want me to do X. And I think that this is the real thing. And you kind of get into this like shadow boxing of communications. That's obviously in some ways unavoidable, but also, problematic and does not end up direct. And by the way, in all this stuff, there is some sort of reality out there of what will work and what will not work, but nobody knows what that is.
Yeah. And to your point on communications and to John's point and how this affects the consumer, I think the media plays a role in it. It's a very competitive landscape and you're going to get a lot more clicks or people to watch your show if you're talking about ramp inflation or a recession than if the headline is, things are okay.
Yeah. And like the bank CEOs, when they talk about the outlook, there's always this, things are, as to your point, John, there's always that sort of innate conservatism, but, a run to the middle of the distribution of potential outcomes. They don't talk a whole lot about, Jamie Dimon is maybe a bit of an outlier in this. We're heading into a hurricane, some of this relatively flowery language that he'll trot out. But, for the most part, they don't want to talk down, the confidence of their customers. And there's always this balance of, things look pretty grim out there, but we're doing great.
Yeah.
And, that's that's kind of a mantra.
I was at an event with Brian Moynihan, and he was saying that this was kind of the line was like, our economists are seeing a recession sometime in 2023, but from what we see in our data, the consumers are holding up really well. That's the party line.
We work with a lot of retailers, and I'm in these rooms a lot right now where they're looking at their numbers today, and they're pessimistic to sort of lamenting where things are. But when you step back and say, look, you're comparing yourself to incredibly unreasonable, irrational comps of the last year or two, and we sort of normalize that for what things look like in 2019. This is just a correction that they're seeing. It's not they're not, if we hadn't had COVID and all of the things that, who knows what else could have happened, but had we not had that massive disruption, pretty much most of what we're seeing in retail is exactly what you would have expected linear growth to be from 2019 to 2022. But I sort of get exasperated when I talk to these people about, like, didn't you realize over the last year or two that this was really irrational? There's nothing normal or new normal about this. To like sort of raise the bar of what your year over year comps were going to be against that was silly. And they're like, yeah, I guess, but there's a lot more, a lot of what's happening right now feels very rational, but we're comparing it to times that weren't. And like Brendan says, it's, that the sensational headlines are going to drive the clicks. And so there's a lot more of that out there than, hey, this is pretty normal.
We've been talking about 2023. Where are the forecasts for 2023? What is it? Are we still at like, we're expecting recession sometime mid-year? Is that the consensus now?
I think that's fair to say. I think that the consensus is a mild and short recession. And economists they don't have a stellar track record at predicting recessions. They're usually wide of the mark in one way, shape, or form. So the fact that this is relatively solid consensus means that you can cross shallow mild recession off the list. No, I don't want to be mean to economists, but when you have a science that doesn't allow experiments, just kidding. Anyway, the reality is, again, this is an example of sort of the innate conservatism. They go toward those middle distribution kind of outcomes. It's non-controversial to say short and mild recession. It's certainly in keeping with the yield curve is telling you that that is at least the case. And plenty of other things are aligned with. We'll talk a little bit more about oil prices kind of being another piece of the mosaic in this.
Let's do it. Let's talk about oil prices.
Yeah, well, it is, I think when you look back and look back at the spring, it was like Brent crude was knocking on the door of $150 a barrel. That is a, historic level highs, very, witheringly expensive gasoline prices. And the White House took a beating over it. It was, resorting to releases from the Strategic Petroleum Reserve olive branches to Venezuela. I mean, this was all hands on deck, but there's not that much you can do, of course. And now flash forward to today, and Brent crude this morning is around $76 a barrel, like cut in half. And, it did that while OPEC, early in October slashed their production numbers to try to support prices. And this is, this is happening when China is trying to reopen from COVID. And there's definitely like some positioning aspect in this. The oil bulls got really over their skis. This, oil prices were going to be supported forever and keep going higher. But boy, this is it's fantastic for this is what the Fed wants to see. This is what the Biden administration wants to see. This is what consumers want to see. But from the financial market perspective, the sort of darker message is this is consistent with a really steep, potentially, decline in the coming growth outlook here, despite some of the pockets and, a lot of the resilience that we're seeing and the potential reopening of China.
Yeah, it's an interesting indicator to watch of what's ahead. I mean, we've had, as you said, during the spring when oil was really spiking, we had lots of conversations around how that impacts, so many parts of the economy and just kind of flows through on prices that gets passed on and helps the inflation cycle. So one less problem. I mean, the supply chains also have their healing. The China opening, closing, notwithstanding, supply chains certainly seem to be healing as well.
Yeah. And, this is kind of the from a trader perspective, oil and energy have been, where you hid all year. This is where you got your downside protection. You felt like you were getting, you generated some real upside. The energy sector, while the S&P 500 is down, the energy sector had been up double digits on the year, and oil prices had really held up. and you felt like, OPEC had your back and Russia was still weaponizing energy, and that's not changing. So but there's a capitulation point, and the rumors this week were that big hedge fund Bridgewater was liquidating their oil positions, and we saw yesterday the news that the Keystone Pipeline had closed down, and you get this kind of dynamic where oil prices shoot up, and then the sellers come in, and it basically looks like every rally just gets sold. It's a very bearish dynamic. It's not what people expected, and the Biden administration said they were going to start refilling the Strategic Petroleum Reserve under $80 a barrel. Here we are.
Huh.
Yeah, maybe it's time.
Let's see what we have. We're sitting here on December 9th. We've just got kind of a couple weeks before people start disappearing for the holiday break and the new year. But next week has some action. Brendan, what have we got around the corner?
So on the data front, we get the consumer price index and retail sales. We also get the global PMIs. S&P does them all for all the major countries in the world. But the big event on Wednesday, the Fed will have their final meeting of the year. They're expected to raise 50 basis points, and I think that's baking the cake. The question will be the forward-looking messages, where the market now is pricing in them to then drop to 25 and maybe only be able to do 1 or 2 next year. And more importantly, the market is pricing in Fed cuts in the second half of the year, which the Fed obviously is not giving that guidance.
Yeah.
So it'll be a big week.
Yeah, it'll be interesting to watch all the messaging around all of that stuff. And it does feel like the Fed is, if they still want the soft landing, it feels like interest rates are trending towards the spot where they have to taper off the raises if that's what they're actually if that's how it's gonna end up.
Exactly.
All right, well, that's it for us this week. Thank you for listening to the Macrocast. Thank you to John. Thank you to John. Thank you to Brendan. I'm Matt McDonald with Penta. Have a great weekend, everybody.
Happy holidays.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.